Welcome back to Expediting Change. Man, listen, I always like to pull up on my man Cruz when I come home to do podcasts, but this weather, how I come home and it's a winter advisory, I ain't bring no boots. My Doogie told me I'd be good without boots. I got these Gucci sneakers and they slip and slide in this weather. I love you, Buffalo, but it's almost April. Like, cut it out. The snow is crazy, but I completely digress. I love home. Let's get into this podcast, Expediting Change. Listen, the love y'all continue to give me is beautiful. I absolutely love it, and I'm going to continue to bring you these topics every single day and break it down into micro, small chunks for you to understand, because it's obviously for the positive progression of the culture, talking about financial education, because we can tie finances to anything. So today I have a guest that's going to talk to you about what I call a hot topic, because I don't know if he know yet, he might be finding it out right now, but we might have a large difference of opinion on this one, because I'm a stock guy, I'm an investment guy, I like putting my money in vehicles, I like self-managed accounts. But today we're going to get into his topics, we're going to have some fun. This is Expediting Change. I appreciate y'all tuning in. Let's go.
Why is it you really want to preach, boy? I want to teach more, because I'm experienced.
What up, man? How you?
What's going on, Mari?
Man?
I can't tell you how excited I am to be here, because obviously we go way back.
For sure.
But here's the thing. You've made it a point to make sure that you educate the culture as much as possible.
For sure.
About financial literacy.
Absolutely.
You got a school dedicated to it.
Absolutely.
Shout out to the legacy.
Appreciate it.
All right. I think that it's something that's really overlooked in our society. But what's interesting is that we figure, okay, well, I come from a marginalized.
Wait. You so excited. You ain't even introduce yourself,
I'm going to get there. I'm going to get there, brother. I'm going to get there. Don't worry. I'm going to get there. I'm going to get there. I'm going to get there.
As we going in, baby.
Because at the end of the day.
Say I disagree with you and said you had to go.
I was like, oh, come on.
All right,
come
go
on.
ahead,
So I'm going to tell you though, because, you know, it doesn't matter if you're coming from a marginalized or an affluent society. If you're rich or poor, whatever, there are people who are like, I don't want to talk about money.
For sure.
Talking about this, doing expediting change,
for sure,
I think is super key.
Appreciate it.
And you're saying like, man, I didn't slate myself, because who am I? I'm St. James, you know?
No doubt.
And my goal and what I do is I teach people how to make better choices with their money.
Okay.
A lot of people don't get that. Like, well, what does that mean? It sounds very vague.
Yeah.
Well, over the pandemic, like I had to do a complete 180 in terms of career, in terms of mindset, in terms of everything, because I'm kind of just, you know, sitting at home. What am I going to do?
Yeah.
I'm getting a little bit of money here. Stuff is popping off from different investments or whatever. And I'm like, well, I know that there's something missing.
For sure.
I've always been in speaking. I've always been in sales.
What was missing though? Like just that natural, what was it? Like, was it innate? Did you feel some type of way? Was the money not enough? Was it because of the pandemic? Was it, you know what I mean? Like, what was it? What was that feeling? Because just in case I'm at home listening, tell me what that feeling is, just in case I'm feeling it.
Unfulfillment.
Okay. Ooh, I like that. Wasn't
Sincere,
satisfied.
emotional unfulfillment. I was working way too hard for way too little.
Say that again.
I was working way too hard, sacrificing way too much for way too little.
Dope. Okay.
I'm talking working 8 to 10 months out of the year, 16-hour days for $50,000.
So your money wasn't working for you?
No, my money was working for me.
Okay, but not enough.
Not enough.
Okay.
Because when we get to the mindset of exchanging hours for dollars,
talk about it.
We gonna work till we die.
No doubt.
You know what I'm saying? But once we start learning to make money while we're asleep, we're good. And then the next step after that is to learn how to make money after we pass.
No doubt.
So the goal is to help people learn that and realize that they can achieve this no matter what particular predicament they may find themselves in.
So for those scratching their heads, because you said make money while you sleep. Respect, got that check, ready to rock on it. Make money after you die. I'm not scratching my head on that, but anybody that might be scratching their head on that, you got to dig a little deeper into that.
Okay, so there's things called trust.
Yeah.
We hear about trust fund babies.
Yeah.
And we always allude.
My daughter says she's a trust fund baby. Cut it out, Shari. You're not a trust fund baby. Go ahead,
but no, the goal is for all of us to be trust fund babies. And maybe we're not living in Bel Air with Will and Carlton. Yeah. But the goal is so that our money and our financial mindset outlives us. Yeah. Think of it this way, all right? Some people, some families have wealth.
No doubt.
And usually that generational wealth, which is a big buzzword right now, it dies off after 3 generations. Think about it. You've worked so hard. You've developed all this huge real estate portfolio. You have bought these particular businesses, and you've passed them on to the next generation. They are like, okay, I saw how dad did it. I see how granddad did it. But by the time it hits that 3rd generation, it has already dispersed. The businesses start failing, and stuff gets sold off. And now it's like, well, we used to be rich. I don't know what happened.
What you think the number one reason for that is?
I think it's not enough struggle.
Okay. Not enough struggle for the individuals that were the trust fund babies that came behind all the wealth that was built.
And to a degree, it's a bit of an entitlement that this money is always going to be here. Hey, look, who's victim number 1 of it? This dude right here.
No doubt.
Because sometimes when I've got a few too many zeros in my bank account in the correct direction, like trust, I'm like, yeah, I've always wanted this rare collectible that serves absolutely no purpose. I want this Colin Kaepernick gold dipped, collectible, because why not?
Did you buy that though? I hope not.
I plead the fifth.
I hope not. I hope that was just a random example.
It's just a random example. So by developing trust, what happens is your methodology of thinking gets to outlive you, and it's going to be able to help your family learn how to live with money.
Absolutely. I like that.
All right, because there's a lot of generational misnomers. I've got friends who come from very affluent families, and they're like, and when I try and show them and talk to them about these concepts, we don't talk about that. Well, why the fuck not? Like, do you want your kids to be broke? Like, are you trying to I don't want them to worry about money. Which is kind of an entitled thing to think about. Because some people, that's all they can think about because they are financially impoverished.
And it's actually a flip because that thought process is we don't talk about money, the adults to the kids, because we're without and we don't have it. So this conversation is an adult conversation, not necessarily a child kid conversation, because we're not going to talk about the means that we do not have. So you're saying it's flipped on the head, all the way around. That's an interesting perspective.
Right. Financial scarcity is the sophisticated term. In the hood, we just call that shit being broke.
No doubt, for sure.
You see what I'm saying?
For sure.
And yes, so by setting up a trust, let me not get too off topic before my ADD kicks in.
No doubt.
And what it is by setting up a trust, you can set up a certain guidelines and rules about how you want to have the money, the family money, handled.
Absolutely.
And you could say, well, look, you're my son, you're my grandson. If you want to get into the family wealth, by age 21, you need to have graduated from school. You would have need to learn to earn your own money by a certain age, and then you're entitled to the family quote unquote lottery.
Absolutely.
Because if you don't grow up in learning how to deal with these dollars, you're going to waste it and you're going to blow it.
You're going to be Tyreek from Power.
Hey, Shazam.
That's what Ghost did to him.
Exactly.
Graduate from college first.
Exactly.
Then he can have his bread.
So that's one key thing. And then the big example that's a lot of people are talking about is the difference between the Vanderbilts and the Rockefellers. Okay, the Vanderbilts, after 3 or 5 generations, their family money fortune is gone. Anderson Cooper was lucky that he got that job on CNN. You know what I'm saying? And a lot of people, they're like, what are you talking about? Well, they were never taught about these multi-generational trusts and paying into their life insurance and having that life insurance money compound so that generation after generation, your family name lives a lot longer.
Legacy.
It's all about that legacy. And that's why the Rockefeller family, now 7 or 8 generations in, is actually a wealthier family name, because what happens is as soon as you're born, that policy is that whole life insurance policy that you are so adverse to.
Here we go, y'all. Here we go.
That whole life insurance policy that you're so adverse to, what happens is it's already paid into, it's already growing and compounding, and it's using the most effective asset that people have when they're young, which is freaking time, bro. You get what I'm saying? So
So let's get into let's get into this. Before we get into the debate about whole life, you said something interesting I want to talk about. Compounding is a mean word, bro. Like,
dead ass.
Both understand that completely. But let's talk about compounding. First explain what compounding is, and then let's get into it about compounding within whole life insurance, and then that's when we can put the gloves on.
So a lot of people, they hear about interest, They hear about interest and they hear, okay, well, I'm going to make a 5% APR, 3%, 0.03 APR, which is, I believe, the standard currently for a traditional savings account. And the median savings account has about $5,300 in that sumbitch. All right. That's barely covering people's 3 months worth of their expenses, which should be your reserve and emergency fund.
Waste of time putting it in a bank account.
Oh, if your money isn't moving, you're losing.
Yeah.
Think about it. Like our inflation rate alone is 3.5. They want to get it to about 2.4. I know this is a lot of numbers for a lot of people, and my eyes glaze over when I hear numbers too. And one of my things is that I teach finance, but finance can be fun.
No doubt.
You can steal that, but trademark me.
No,
I just get a royalty.
No, we dope. No,
All right.
We got it, but I might steal it. You
No
have
problem.
to come sue me though.
Okay.
I know where you live.
All right. So the premise is this. Your interest is making interest.
No doubt.
As opposed to just the money, basically the principal that you put in, that $1,000 that you put into a bank account.
Yep.
If it's getting that 5% interest, I believe that it works out to being about $5. If I'm just going off the top here. But year two, it's only that $1,000. Well, why not make it off that $1,005 which is in there? And a lot of people who are, drowning in credit card debt, which I definitely was, those compound interest charges on your credit cards, they will bite you in the ass. They will eat you up. They'll eat you up really bad. So
especially American Express.
Oh, well, listen, that's
25-30%.
But here's the thing though. Amex.
Yeah.
All right, we're gonna get off just a little quick. Amex is a charge card.
Oh, absolutely.
Versus
that was 2 podcasts ago.
Well, damn. Okay, there we go. There we go. So Amex is meant so that they can charge a lot of these merchandisers a higher fee to be part of this elite club of people who are highly affluent, who are going to want to pay off their balances after every month. And if you carry a balance, that's 22, 25%. But for people who own these LLCs, well, they're like, well, this is the interest. It was all business expenses. I get to write this interest off. Oh, well, come and catch me. And Amex is great. You get great points. And obviously we could do a whole another conversation about that. But the situation with me was I had way too much credit card debt and I needed to find ways to accelerate my repayment schedule to pay them some bitches down.
No doubt.
Using the same weapon, the same instrument of destruction that those credit card companies are using against me, which is compound interest.
No doubt.
And that's exactly where whole life insurance comes in, because now what you're doing is you're able to use the equity in your own dollars to make money 2 times. And once I heard about it, my immediate reaction is, fuck this, I hate numbers. And 2, I don't believe you.
No doubt.
Think about it.
If it's too good to be true, it might be.
It usually is.
No doubt.
When you come from the block, you're used to seeing people who are scamming. And if you're coming to me with something that's a little bit too sophisticated and something that I can't ground my mind into, bruh.
Might be a little too much.
It's a little bit too much for me. I'm good.
You know? Well, Amex, you've probably been mentioned on my podcast about 3 or 4 times. I think I have 4 platinum cards and like 2 green cards just to have the green card. So it's about time you sponsor my podcast. So we're gonna pull up Amex. I'm pulling up on you. I mean,
it's not too late to switch to Chase Sapphire.
I like my Amex points though. I do like my platinum card, and it's heavy. I like that.
You like the clink.
I like the heaviness.
The clink,
you know what I mean? But let's get into it, man. Let's talk about this whole life. I'm gonna set this conversation up right here though.
Okay.
I am, and I want you to respond to this, so it's not necessarily a question. I am of the mindset that as opposed to a whole life policy, and I'm not saying it's mutually exclusive, like you can only have one. We know that. But for sake of the conversation, I am of the mindset, why would I have a whole life policy when as a whole life policy dictating what is being purchased in the market versus a term policy where I just drop this short bread on a term policy and I take that same money that I will be putting into the whole life, because the whole life is going to cost me more, and I put it into the market. Because for me, ideally, if I'm going to take that money and I'm going to put it in Apple going to give me a 4-to-1, 7-to-1 split. Chipotle just did a 50-to-1 split. I don't know if y'all seen that, but a 50-to-1 split.
That's ridiculous.
So, I mean, that's crazy. So talk to me about that. Maybe that is a question. Why would I put it in a whole life policy as opposed to putting it in Chipotle?
Okay. So what we're talking about is ownership and control.
Okay.
And a lot of people, when this concept got introduced to me, and they're like, you know what I like most about whole life is the control. I'm like, I'm in control. If I have a stock, I can sell it. If I don't like it and I get scared, I got control. I got my money in my hands. So I'm good. They're like, no, it's not like that. Well, okay, a 401k, you don't have control over your 401k. They put it into this fund and it goes up and down now.
Unless it's self-managed, though.
Unless it's a
I can have a
self-managed.
self-managed portfolio.
Right. So we have to first delineate the three different types of insurance. There is a term insurance where, you know, you have a 20-year span. It usually has a very, very low premium. And it could be as low as $20, $5 if you're really young.
With high payouts when you're as healthy as I am, with really high payouts.
Exactly, because you're probably tier one, the picture of fitness, right?
Well, I don't know about the picture, but I take that.
Okay.
You're invited back.
Okay, perfect. The next one we have is whole life. And whole life basically is you having a fixed rate of payment in perpetuity. And then the third, which is a newer product, is like a universal whole life, which is something that's tied to an index. And that's what I think a lot of people think about when they think of, okay, it's whole life. It has a very, very high commission and is being pushed super hard in the industry right now because we've had this massive bull run in, you know, the NASDAQ. Like we hit a trifecta, the Dow, the NASDAQ, and the New York, the other one, I can't remember what it is, all went up massively this past day. And a lot of people are like, well, if it's going up, it's great. And if it, you know, goes down, then I have a floor. Yeah. So between those three different types of insurance, what I think you've kind of explained to me is more of a universal life versus a whole life, which is very, very boring. And it's actually one of the oldest forms of insurance that's out there. Because
what do you mean as I explained it to you?
Because you said it was tied to a market that you couldn't do anything with.
Exactly. Okay.
What I'm talking about with this whole life is tied to the government. Okay. It's tied to the same thing that backs our green dollars. Okay. And these insurance companies are smart. They know that they've got these actuaries, which is a super high level accountant who can say, I know that Shomari is going to pass, he's going to expire, he's going to graduate at 115 years old. All right. He eats way too much kale. He works out way too much. All right. And he's trying to catch up with that dude, St. James. So that's what's always going to happen. Okay. So they know, all right, look, if I put you on this term, let me ask you actually a more dynamic question. Do you rent or own your house?
My home?
Your home.
I own it.
Okay, you own it. Do you rent or own a car?
I lease it. I only lease.
You only lease. Okay.
Yeah.
No, sounds good.
So you call that renting or owning?
That's more renting.
But I own my Range Rover, so both.
Exactly. Okay. But that's choice. That's of your choice, right? Because you get different benefits with leasing, but we're not going to digress. But you're choosing to rent your insurance. Who has control? When you have term insurance, you are renting your insurance.
Why you say that?
Because it builds deeper. It builds.
Because you're not building any equity.
No, zero equity whatsoever.
Good argument.
Okay.
I won't knock you on that. Good argument. Go ahead. I have a response, but go ahead.
And here's the kicker that a lot of people don't know, and you can check this up on bankrate.com. Over 90.
Look at bankrate.com.
All right. So over 90% of term insurance policies never pay out. Versus whole life policies have a over 95% chance of paying out. And a lot of people don't know this. A lot of people don't know this because they're like, oh, it's whole life. I have to pay this for the rest of my life.
Yeah, but that statistic, though, you would have to add more metrics in there. How many people have whole life versus how many people have term? Are we talking globally? Are we talking New York State? Because that could be factually true, but if there are more people with whole life than less people with term, then so you got to quantify that a little
We're talking
more.
100 people versus 100 people, same sample size. And of those 100 people who have term, 90% of them are never going to get that final payoff, that big jackpot. Versus whole life is pretty much the inverse.
So the equivalency that you're drawing, though, that's the point of term, though.
Well, the thing is if you want term, remember, 90% of people are never going to get that payout from their insurance. So that means whenever they start, we're going to say that it's their early 20s, all the way to when they retire and expire in their late 80s to early 90s. They will not get a term policy. Their term policy will not pay out for them.
But once you expire, that term policy pays you out.
No, that's what I'm saying. Because they don't renew.
Oh, make sure you renew your term policies.
Well,
That's just crazy.
But remember, these actuaries know when you're going to die. Oh, you're from this zip code? Bet. Oh, you're African American? Bet.
Yeah.
Chicken? Oh, okay. And
chicken.
all right. Okay. So for you to renew on your fixed income, sir, now that you're collecting your Social Security income, now that hopefully your house is paid off, for you to renew, it's going to be $250 a month.
So you're throwing in a qualification. You're adding in an additional metric.
Yeah.
So you're saying that if I don't necessarily have the means,
correct,
then it is a better option for me to look at whole life.
Precisely.
Because regardless of what that premium personally goes to, I can afford it. So I'm always going to renew it because I'm also of the mindset that I want to make sure that I leave legacy, and if something happens to me, my family doesn't have to worry about it.
Agreed.
So you agree with that statement?
I agree with you on that. But by that same means, you'll be able to achieve the same and more with the whole life.
Okay.
With a standardized whole life. So let's talk about the different benefits here. With term, yes, you do get a good payout, and yes, the fees, basically the premiums are cheaper. But you can basically do what Dave Ramsey says you could do. Buy term and invest the difference. That's presuming that, you are going to invest. Okay, cool. But let's take that a step further. You want to buy whole and make your money work 2 times. Because what you could do is let's just say a $10,000 dump-in of overfunding your policy. Now, you can,
but explain $10,000 dump in so it's clear for everybody. Yeah.
So with a whole life, a lot of people think, all right, well, I got to pay this $300, $350 a month, and what will happen is I will get maybe $150,000 worth of coverage. Whereas if I put in $25 a month, what will happen is I'll get $1 million of coverage. Great, no problem. But guess what? You're gaining no equity in that. And chances are, if you're paying $25 a month, you don't have any pre-existing medical conditions. Chances are, this is not, across the board, of course. Chances are you have no pre-existing, no diabetes. You are basically tier 1. And then what happens though is that since you're not getting any equity in this, you're just giving the money away, even at $20 some odd. But you're still putting money. Here's the caveat. You're putting that money into either, for most people, like a savings account, which grows no interest. We've already established that particular point. And you lose the opportunity cost as soon as you pull that money out of your bank account. All right. We have $5,300. We're going to go ahead and knock that up to $10,000 just sitting in the bank. And then you're going to say you're going to put it into a stock. Great. You should still put your money into stocks. That's going to be the allotment of your portfolio. But there also, I believe, if you want to follow this particular gospel, which is open for everybody, I'm not saying that I'm right. I'm just saying this is an option.
No doubt.
Is that what you can do is you can say, all right, well, I also always put money into my savings account in addition to always putting my money into my savings. All right. Well, excuse me, you put into stock into savings, excuse me. So once you get your 3 months of expenses into your savings account, that's very, very liquid. You can touch it, smell it. It's awesome.
No doubt.
Some people get off on smelling money, man. So what you could do now is by putting that same amount into the whole life vehicle, it accrues a guaranteed rate at 3%, not 0.03, but a full 3%. And if it's with a mutually owned company, some of these companies have been open for over 120 years, and they've profited through recessions, depressions, egressions, and every other sessions that you could think of.
No doubt.
You see what I'm saying? And they will pay a dividend, and you will see them making at 5%, which is, and some of these companies have not missed a dividend payout for quite some time.
Reinvest in that dividend, or is that dividend a direct payout to me as a whole life owner?
You can choose. Okay. So you can do a paid up addition so that you have more, what's now known, which is the next step of this, is your cash value. Now with this cash value, you can pull this out. You have to think of this like a HELOC. You can pull out.
You got to explain HELOC.
Okay, home equity line of credit. You're right. Home equity line of credit. So if you buy a house, over time, that house goes up in value just by the nature of our economics. Also, you have equity. You have value within this house that you can pull out because you've paid down some more of your home. You've made payments on your home. So now you have this value, this stored value that's sitting in the rafters of your home. And what a lot of people like to do is take money in terms of equity to pull that equity out of their homes and do investing. Maybe they'll use it for a down payment on another house. And now you have your rental property, or they're going to fix up their own house and raise the value of that. And they'll do, other financial stuff with it. So if we're doing that with our home, if people take out equity in terms of their business and say, you know what, my business is this valuable, maybe I can solve some of this equity in it. Why don't we do that with our money?
Well, one, I think some people just don't understand it fundamentally, which is why you're here explaining it very eloquently. I like it. But I think the one thing, though, that you have not convinced me on is the comparison between, I like single stock exposure because I grew up on single stock exposure, even though I know that is risky. But where you haven't convinced me, though, is that I'm not mentioning anybody's name that has a podcast. You did. I'm not. But me being able to take the delta, the difference in that term policy that I'm not paying, and then I can buy as I go. So if I'm living paycheck to paycheck and I only have $20 this month and then $100 next month, I need you to convince me on me not doing that, being able to pay for it when I can, as opposed to I'm always going to have whatever that set premium, whatever that set price is that I have to pay monthly with that whole life.
Okay.
That's huge for me.
I agree.
Not for me, that's huge for other people.
For other people. So yes, we are talking about different levels of sophistication and access to finances. And we are talking in this particular example of somebody who is able to both save and who is also able to invest.
Got a little bit of dispensable income.
Disposable income. Dispensable. Yeah. Dispensable is when you buy a gold-plated Kaepernick statue. You get what I'm saying? So
No
I agree. If you are somebody who's only able to afford $25, I don't even want to say afford, but to invest $25 into a stock. Here's the play. You ready? You find an insurable body. Somebody who's within arm's length to you, a child, a family member, a loved one, who you could still get a whole life policy for and overfund it, okay? Because now you can still borrow from that policy, and then what you could do is now you can use it to purchase stocks. I don't recommend this strategy, but in this particular tangent, it is an option. I'm not on board with it, but
for that.
I'm not definitely, because you should be more fluent than that. But if you're like, hey, look, I got to start and get into the game, absolutely.
Okay.
But speaking on that point, I do recommend, and I'm going to say this probably twice because it's so dang on nice, man, bruh. If you have kids, if you have children, the very first thing you should do is buy some form of whole life insurance for them. Because let's just say that we do $389 per month, okay, which is a lot for a child. I agree. But if you're saving that money anyway, you are now setting that child up for success.
That's under the assumption that you can afford. That $389 is a lot of groceries.
That's a lot of groceries.
That's
yes,
rent. That's a lot.
Right.
I don't know if that's a fair assumption, a safe assumption.
I was under that kind of mindset as well. And I know that like right now these times are tough, but we have to adjust to thinking I'm saving this money anyway, and if I plant the seeds now, they'll grow later. And I'm using 389 specifically because the financial is stuck in my head.
Okay, no,
that's the only reason why.
I'm gonna let you finish that, but then tell me if I'm on the margin, how do I do this if I'm on the margin? How does this work for me if I'm an individual who's paycheck to paycheck? But I want you to finish, well, two things. One, I want you to finish that point, or maybe three things. Answer if I'm on the margin, but I do want to get into this overfunding because you mentioned it a couple times that I want to make sure that we get to it.
Deadass. So we're talking 389. And I'm going to say 389 by age 18, you would have amassed because of compound interest with never pulling out any of the equity of that particular policy. What will happen is that the 18-year-old child that you can turn this around to will have, I believe it's well over like $110,000 worth of equity in their policy and well over $400,000.
Not overfunding. This is just me paying that
just put it in there. $389. Boom, 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 boom.
The age they are,
yes,
5, 6, whatever, to 18.
Exactly. Okay. Just keep putting in. That's just the power of compound interest. Now, if an emergency does come up, you can pull from that policy and pull the equity out, take care of your business, pay your money back, or you can pay it back never.
Yeah.
because it's an advance on your death benefit.
So here's my counter argument again, though. So for the same thing, I can open up a stock account, a brokerage account for my son. I could buy him Sprint stock when it drops, and it's trash, so I'm getting it at $2. They are then bought out by T-Mobile. Now he has hundreds of shares of Sprint. Now it converts to T-Mobile, and now he still has that 100K.
Exactly. And that's where our divergence in gospel kind of deviates, because
Okay,
I'm
no
thinking,
doubt.
like, do both.
Okay,
You see what I'm
respect.
saying? Like, pull the
Respect.
equity out. But the thing is
Respect.
that on the back end, my policy, no matter what, is guaranteed to grow at that guaranteed 3%
Yeah.
and future dividends.
No doubt. And I'm going to help make your point. I'm going to jump to your side. Also, on that note, there's no insurance policy specific, not on my family, but specifically in that example that I gave.
Right.
That's just the finance of it. It's nothing tied to if something happens to, God forbid,
Exactly.
anything happens to anyone, but especially my children.
In that particular example, yeah.
Absolutely.
And I
Absolutely.
mean, I understand that, but some people, when they see stocks, they're like, do I pick the right one? What do I
doubt.
learn? And that's why you need to have good mentors who can say, hey, look, you basically got to do the opposite
No doubt.
of whatever you feel. If you see that I'm in a semiconductor company right now, like like really, really major position.
Yeah.
When I see that it goes up 30% month over month, and I'm like, I want to buy more. It's like, no, bro, sell and buy the dip.
No doubt.
You have to be counterintuitive.
doubt.
And that's the same premise that we have to teach people as well with like insurance.
No doubt.
Okay, why the heck do I have insurance? Of course, it's not in our community. That's why we selling fish dinners, bro.
No doubt. No doubt.
Like, we in the block. If you get your policy, it doesn't have to be $389. Get that out your head.
For sure.
I'm not talking to you. I'm
No,
talking to
no,
that
no
dude
doubt,
over
no
there.
doubt, No doubt.
If you get it, if it's 10 times your child's age, you good.
No doubt.
So if your child is 2, all right, 10x, $20. Guess what? That, you good.
Say
But
that again. I like that. That's
10x
simple. I like
your
that.
child's age.
Absolutely.
But I would just say, just go ahead and move up to 100.
No doubt.
If you can afford to buy new sneakers every single month,
Ooh.
which a lot of
Now you preaching. Okay.
don't know, because I can't get hyped.
No, no.
You know what I'm saying?
No, that now this is how you convince me. This
Yeah.
is how you, instead of buying them J's, them new Jordans that came out. Yeah.
Just buy into your child. Invest into your dang on child.
No doubt.
You know what I'm saying? You know your child's going to need a car at 16.
No doubt.
Let me take it back even more.
And don't forget, we gotta get to this.
Oh, no, let me answer that question for you right now.
The
Let me-
compounding, the overfunding.
Overfunding. So,
go ahead,
but
finish that point,
cool.
though.
But no,
Yeah.
we do have the means. If African Americans, if the culture is the #1 consumer in America, why the fuck can't we afford fucking life insurance, bro?
Okay, might be a choice.
That's a choice.
Might be a choice.
And it's also lack of education.
No doubt.
And if we're choosing to watch Sexy Red shake her ass with a belly in her stomach, all right,
No doubt.
cool. I hope she insured her child too.
No doubt. No doubt.
You know what I'm saying?
Yeah.
So boom, let's check this out. I got it. There's a thing called the Stanford Marshmallow Study.
Okay.
You're gonna like this one because I'm gonna talk about this at your school.
You predicted it.
All right, check this out.
You hear that? He signed up.
The kids,
Volunteer.
volunteered. All right, they put kids individually into a room, and in this room they put a marshmallow onto the table.
Yep.
It was clean.
Yep.
And they said, "All right, Jimmy, Lennox, whatever the next kid's name is, Steve. This marshmallow is yours, but I have to go do something right quick. And when I get back, if this marshmallow is still there, you get 2 marshmallows." So, all right. Now, of course, the researcher leaves and then comes back. Now, some of them kids, they were like, screw this. I might eat the marshmallow.
Right. Instant gratification.
Instant gratification. Whereas the children who expressed the highest levels of delayed gratification, they did the follow-up study 20 years later, they found out that they had higher rates of graduation, higher rates of median income. So they are predicted to be more successful down the road than the children who just faced the immediate gratification and ate the marshmallow.
So was there anything in that study where they taught that? Was it innate? Was it cultural? Like, there's so many different factors.
Those are the weeds, and we don't have all that yet.
Okay.
Not right now.
No doubt. It does matter, though.
It does matter.
Though.
But the premise is this: even if it's not innate,
Yeah.
it can still be taught.
No doubt.
And it's hard to do, man.
Education, it's tough.
I really want that statue, bro.
Right.
But you wait till you have enough money for 3 of them.
Yeah.
You know what I'm saying? You have to, it's the mindset. That's why in every self-help book, they talk about mindset, because it all begins with that.
Absolutely.
And now what the hell does that have to do with life insurance? Because if you plant the seeds while they're young, if you plant the seeds of financial literacy while they're young, these concepts are not as foreign to them.
No
They're
doubt.
not so outer space to them later on.
Absolutely.
And you're not 30 years old, 40 years old, trying to play catch up with these people who have been taught about it from the beginning of their life, who are with these generational families, with people of the Rockefellers and the Waltons and the James family. Because my name is James too, so I can say that. You know what I'm saying?
Speak into existence.
Dead ass. I was teaching my youngest daughter this when she was like 3 years old. Now she knows about this.
Who's in the room, by the way? She's love.
She's my producer. She's the producer. You know what I'm saying? So, that's the premise. And the thing is with this life insurance, well, I remember, this is going to be one of my last stories here. I'm starting to sweat because I'm into this, bro.
No doubt.
I remember I had a huge payout from one of my jobs. I walk into the bank. I'm like, yo, if I hold on to this money, bro, I'm going to spend it.
No doubt.
So I go into the bank and I say, is there anything I can do with this money? And it wasn't no real money. It was like 5 stacks. You know what I'm saying? I'm like, what can I do with this that I can just be hands off? He's like, well, you can put it into a CD.
Yeah.
Brother.
Yeah.
The look in disgust that swelled.
But say, I know what you mean. Say why. Say why.
Because the CD
and why.
The CD, I have no control. My money is locked up.
That's right.
And while I'm making maybe 2 to 3%, they're making maybe 1,000% because of the fractional bank.
That's right.
Because the way the banks work,
absolutely,
they can make a lot more money.
Absolutely.
All right.
Good point.
And I wasn't into the investment game at that time. I wasn't really ready for risk.
Yeah.
And I wasn't in the right circles at the time to really be able to take advantage of whatever opportunities are out there.
Absolutely.
But everybody who's watching this podcast, everybody who just may hear this fleeting, you can get in those rooms because of social media. You can get in those rooms just by going to the right place. Go to a real estate meetup. Hey, my name is St. James. I don't know nothing about this game, but I want to learn about it. What can I do to help?
Watch
How can I be of value?
Expediting Change on YouTube, TikTok, Instagram, Facebook, wherever you get your podcast, Expediting Change.
Absolutely. So we have the means to do this now. So when he tells me that all I could do is a CD, I'm like, CD? You can see these nuts. You know what I'm saying?
Crazy,
so,
dog.
but if I had seeded my whole life insurance policy at that particular point, how much more money would I have had? Now, yes, do I have to make consistent contributions? But guess what? I don't stop putting money into my savings account. So again, I have my 3 months reserve, and then now all the rest goes into my whole life insurance policy so that I can pay myself back. And if I get into credit card debt again, I can borrow from my policy. Because let me ask you this, because we didn't finish up this part. Amex has a 26.
What, percent?
Yeah.
I think it's either 24 or 26.
25.
Yeah.
25% interest rate.
Crazy.
If I have that sitting in equity in my life insurance policy and I only have to borrow at 5%, I've just made a 20% return on my money.
Good point.
And I don't have to pay that back.
And you're paying yourself back if you do.
That, ladies and gentlemen, that's infinite banking right there.
Yeah, no doubt.
So that is why I'm so adamant about this. That's why you got a dude who's in extremely good shape flailing all over the place talking about this, because that's the premise.
No doubt.
And you cannot do that with term insurance.
No doubt.
It's not this or that when it comes to it being an asset. It's not an asset, it's a mind state.
No doubt.
It's this and that.
No doubt.
The two can run parallel to one another, so that you, your family, your loved ones can achieve their financial goals. And then if the price point is too high as an adult, you still have to have insured. You still have to be insured yourself. So you get yourself your little $20 policy or something like that. But then you buy your child the whole life.
No doubt.
And that child is now going to be invested in, and they can do. There's so many different plays with this, bro. You take that equity that's in their policy, you put that into a real estate deal. All right, you take that equity, you put that into a stock market. Make sure you know what you're doing.
Absolutely.
You know what I'm saying? Like you're gonna, you really want to invest in doing option plays?
Right.
Bet.
Right.
You see what I'm saying? Or you become the bank on other deals.
Yeah.
People, there are electricians, there are carpenters,
Hard money
there
deals.
are
Loans.
hard money loans on equipment
Yeah.
that they amortize and pay you back. But instead of maybe their credit isn't good, maybe they don't have access to good credit cards.
So to your point too, I want to add, I want to pull on that thread. Oh look, compounding again. It came to me that I had to say that same 5,000 for a CD. You could take that 5 stacks. You could put it in a savings account and not earn a lot of interest. But if you know that you're going to spend that money, you divide that out based off what the whole life policy is going to cost you monthly, and you use that 5 stacks to actually pay for your whole life policy.
Shazam.
You know what I mean?
There we go.
You know what I mean?
There we go. So I put it into NVIDIA a long time ago.
Okay.
So
that's dope. You good.
We all right.
You taking me out to dinner then, huh, man? dinner on you.
No, I didn't go single stock. I'm front. But yeah,
No doubt.
I made sure I liked it because they did video games.
Now, you talked about a lot of concepts, bro.
Right.
A lot. We talked about compounding. You talked about infinite banking. You talked about whole life versus term. So if I'm watching this podcast, break it down for me. Just the 3 things that, like, what's most important? Like, if I'm starting out, and let's not say a multimillionaire or somebody with the bag, and let's not say somebody who's living paycheck to paycheck. I believe ultimately it's not going to be a middle class. It's not even really a middle class right now, and it's moving to the haves and have-nots, which is so
Absolutely
terrible. But let's say in the middle somewhere. Give me the 3 things that I need to walk away with, because I need actionable small steps that I should take based off what you're recommending.
Okay, thank you. So first off is understanding your budget.
Okay.
Can I invest in myself or a loved one to get a whole life insurance policy? But here's the caveat: with a mutually owned company that pays dividend. I'm talking Lafayette Life. I'm talking One America. My policy is with New York Mutual. Okay, because those are the ones that have these types of returns. You can reach out to me.
I was about to say, how do I find that out?
I'm at St. James. All my socials are at St. James. At St. James Wealth is the one that I focus more on things like infinite banking.
Yep.
But if you just read me at St. James, the number 2 ND, all right. I'm sure Mr. Cruz will be able to hook me up with a nice graphic for that, or somebody on the team. All right. At St. James, the number 2 ND, what will happen is they can reach out to me, schedule a call. I'm gonna break it down for you as easy as possible. And trust me, like, I had to learn this stuff too, and I understand how long it took me.
Yeah.
And I just learned ways to make it simpler.
So say that first one again, so it's clear. What the first step is what?
Finding a company that is a mutually owned insurance company that pays dividends.
Okay.
And also determine your budget.
Okay.
Because in order for this policy to work, it is 10x your age.
Okay.
It is 10x your age.
Okay.
And definitely, then the next step is
number 2. It's number 2 now.
Remember, delayed gratification. Don't come at me and be like, I have $1,000, I'm gonna pull $1,000 back out. No, you're only gonna be able to pull out maybe 80%, 75%. But also have a clear-cut goal in mind.
Yeah.
And right now, U.S. consumer debt is over $1 trillion, well over $1 trillion. Let's make that the first place that you reap the benefits of this. You take some money from over here and you place it over here. So now you are saving that 20% spread year over year to accelerate your debt repayment. Don't worry, no shade to all those people who do credit repair and debt consolidation. I got no shade to y'all.
No doubt.
But this is a method, this is probably one of the most powerful methods to repay debt. And number 3 is make sure that you teach your family members and your loved ones, especially the ones with the children, to get on this early.
No doubt.
Because if you're already in your 30s and 40s, it's going to be very hard for you to develop this generational wealth.
No doubt.
We have to be planning 2 generations deep.
Absolutely, if not 3. No doubt.
And normalize principles like this. Normalize talking about the stocks, the insurance, the trusts, the infinite banking concepts, and obviously the delayed gratification.
No doubt.
Once you've achieved what this particular milestone is, you started paying yourself back. Once you've cleared off your debt, It is now going to the next step, which is step 3, and finding ways to grow your wealth. Your money cannot just sit in a bank account because money has to be in motion.
No doubt.
You have to be able to outpace inflation.
Absolutely.
And
what does that mean? Stay that. Pull on that.
Okay,
that. Outpace inflation.
Outpace inflation. And so again, I think
first up, what is inflation?
Inflation is basically the cost of goods and services within an economy and how much that price changes year over year. Now, I got a trivia question for you. What consumer good? Okay, I'm going to give you the answer to them. What consumer good has not gone up? Not consumer good, but it's like a commodity that hasn't gone up in price in well over 20 to 30 years, and a lot of us eat them every single day.
Skittles.
I'm afraid not. It's actually bananas.
Wow.
Like Trader Joe's has had 19-cent bananas for well over 20, 30 years.
That brings so many more questions that we got to.
Well, I guess you have to have me on part 2.
Yeah, absolutely. Or at the bar. So like,
you know what I'm saying?
Because avocados went crazy. We're digressing, but avocados went bananas?
Yeah, and we'll be able to talk about that later. Yeah, that's B-A-N-A-N-A-S, right? So that's the premise. So once you have found a way to, people are like, I don't know what these guys are talking about. They were just talking about money. Now they're talking about bananas. These motherfuckers don't know what's going on. But the premise is this, though. Once you've cleared off your debt and your plate is clean.
Yeah, outpace inflation.
Yeah, outpace inflation. So, okay, so again, outpace inflation. We are at 3.5 debt. The government wants to be at 2.7. All right. That means our price of goods, the price of cars, the price of groceries, the price of shoes, the price of daycare has gone up year over year at 3.5. And some of these things haven't come down. Price of cars has barely come down. Yeah. The price of flights, you know what I'm saying? Yeah. So what we need to do is make sure that our money is making more than 3.5%.
Absolutely.
And the way that you do that is you call up the electrician, you call up the person that's a home flipper, you call up that wholesaler, you call up some of these people who need marketing dollars, but maybe they don't want to go through all the hoops that a bank will make them go through. Yeah. Because banks will know everything but your mama's maiden name. Actually, they do want to know your mama's maiden name.
Yeah, and birthday.
And blood type.
Yeah.
Like, bro, I don't care.
Right.
Show me the proposal.
For sure. Show
me that you know how to make money and what is your track record.
For sure.
And the more risk that you are to me as a lender, the more points that I'm going to charge you on the deal.
Yep.
But if we have a very good and established relationship, if I know that ATOJ Solutions and Legacy Solutions, I took it way back. If I know that you are a company that is looking to grow and you're buying these tangible assets that I can repossess, then what I can do then is I can put a first lien holder position on some of these things. And I know, guys, I'm sorry. I know I'm using a lot of terms, but I respect your audience as well. I know that they're going to be able to look this stuff up. But basically, if the shit don't work out, I can take it back.
No doubt.
If my man's want to open up a delivery service and he needs a truck or he needs fuel costs, all right, bet. Yeah. But I own this truck. Make no mistake about that. And I got 3 trackers in this sumbitch, so you don't think you're going to run off in the middle of the night.
No doubt.
That's what I'm talking about.
For sure.
Learning how to make your money grow, and I loan this money over that 3.5%, so I am outpacing inflation.
Outpacing inflation. And another tool, just because I'm on the fence and it's not necessarily what I do with whole life does not mean I haven't researched it and don't believe that it won't work for other people. Another piece, function, tool, when you have that trust and you have a family, tight-knit or not, come together, sit around at the table, and you have a death member benefit. So everybody says in the family, mom, grandma, kids, hey, if something happens to you, written into this whole life policy, a function of that money does not just go to you and your nuclear family. You also put it into the family trust.
Dead ass.
So now as people pass, that builds and builds. And that's not a Shomari brand new concept. That's called an endowment.
Exactly.
Right? Like some colleges and universities have billion-dollar endowments. How do they get those billion-dollar endowments? Because people have dedicated a portion of their whole life insurance to that endowment. So that's another play. I just gave you another one. You can use that
one. So
you
ready for this, though?
Yeah, shoot, fire.
Why do you think that Walmart got in trouble for putting all these insurance policies on people and they didn't even know about it?
Yeah.
Because they would pass and now they're able to receive that money and it's tax-free.
And get the absolutely.
If I put money into a 401k, great, I don't get taxed on it.
Yeah.
But guess what? As soon as you pull out that money out of that 401k, you get taxed on it.
Coming for you.
And you don't know what that tax rate is going to be in the future.
Absolutely.
If you are, there's so many different people who have done weirdness, these corporations.
Weirdness.
COLI,
No doubt.
corporately owned life insurance policies.
Yeah.
All right. People are like, oh, this is so nice. My employer gave me a $10,000 free life insurance policy.
Yeah.
If they're going to give you $10,000,
What are they getting on the back end?
they're probably getting $100,000 to $1 million.
They're getting on the back end.
Exactly.
No, for sure. For sure.
Exactly.
For sure.
So I know I'm talking.
That's
I
why
know you're
we're here.
weary. I know
It's
you're
a
weary.
podcast.
I know you're tired.
No, not at all.
But I got something else for you.
Go.
Think of it this way. I grew up in an at-risk community, 14215. You could look it up. And
Buffalo, baby.
all day. And it's interesting because if more people had some type of insurance and faced mortalities, which is basically part and parcel with at-risk communities, think about how many lives would have been changed. And think of it this way as well, whether term or whole life. You have three outcomes with this. You pay and then you invest into your child. Now, your child, best case scenario, lives on the straight and narrow, does everything great, you've raised them right. Well, guess what? Now they've got this pot of this investment into themselves that they can pull from to buy their first house, because we know housing issues is a huge issue.
Absolutely.
They can get their first car, or maybe they can reduce the amount of student debt, or use that money, borrow from that money to open up their first business.
Dope.
Okay, that's option one.
Dope. Yep.
Option two, they're a knucklehead. Stuff happens. I'm not going to say they got involved into violence, but we're going to say that lightning struck them. Now we're got to do the fundraiser. But if there was a policy on this child, now the family is able to, at least for in some small means, tax-free, be able to move themselves out of this community, which could have played a factor into their mortality. Could have. All right. And I don't want to say I support this, but in terms of, just tell your kids to go play in the street. No, not saying that.
Not.
You know what I'm saying?
We don't condone that.
I don't condone that. But somebody, this guy doesn't know what to talk about. All right? Y'all know exactly what I'm talking about. Now you have been given the means to get yourself out of those types of situations.
For sure.
Or you could stop being a renter, and now you can say, look, well, we got this.
Sure.
Now we can use this money wisely. We can purchase a house, even
Sure.
though I'm still in my hood. I love my hood. There's times I don't.
No doubt.
But there's times I do.
No doubt.
And another big cool, interesting thing is this. A lot of people don't know this. If there is some level of weirdness going on with the mortality, sometimes these insurance companies like to investigate.
Oh, yeah, and deny.
And they'll deny the claim.
Yeah.
But how many unsolved homicides do we have? Where the law enforcement just says, we're overburdened. The insurance company be like, listen, y'all gonna find out what happened because we don't want to pay out this $2 million, $150,000. We don't want to pay this out, so we're gonna have to put our own investigator on this.
No doubt.
So now we get the closure that a lot of us have been looking for.
And if they pay for it, then so listen, I absolutely love the passion that you have for this. Whether I agree or disagree, what I don't disagree with is the passion that you have to financially educate our people. I mean, that's so much love. So the hot seat question, which I know you're going to murder, you're going to kill it because you just went through this whole series of explanations. I asked you for a top 3. You gave me like a top 8.
All right.
So fundamentally, I do this for the positive progression of the culture.
Right.
I fundamentally believe that a rising tide raises all ships, right? And I started this podcast because there was a lot of stuff going on, a lot of things going on. And I felt from an activism perspective, we got to be out there beating the streets and tearing shit up by any means necessary. I believe in it. But at the same time, we need to impact and make change and teach individuals how we can get into advocacy. So Expediting Change was created to talk about what are you doing right now for the community, for the underserved, for the people to help expediting change in our neighborhoods.
So with insurance, for instance, a lot of people want to go after these big whales. They want to go after the people who already have $1 million in the bank. No. I go to the person who has 2 kids and they want to be able to do something for their kids so that they do not live in the same abject circumstances that the parents have lived in. How can I uplift my children? So I go and I talk to them. I'm not worried about the money. I'm not worried about the anything else other than helping those particular people, because financial scarcity is such a real thing. And once we have a level of financial security and stability, it changes a lot of our outlook on life and helps us progress as a people, because there's intellectual capital and of course there's financial capital. And I want everybody to have both.
I love it. I love it. I appreciate it, man. You killed it today.
All right, brother.
Killed it today.
All right.
Killed it.
All right.
Why don't you shout out all your you know what I mean, your
Absolutely.
media. Shout it out again.
Absolutely. So to reach me, Instagram at St. James, the number 2 ND, ST James, the number 2 ND. You can find me on Instagram. You can find me on TikTok. I'm probably doing something really interesting, talking about money or talking about how you can invest in real estate or with insurance. And, you know, we can go, I'll find a way to get y'all my phone number. I don't remember my business line anymore, but yeah, you can even hit me at james@chrisnoggle.com if you want to email me directly, and I will see you soon.
So this has been the Expediting Change podcast, bringing it to you raw and live. We talked about so much, and I'm so excited to bring this to a close. I'm so excited to sum this up. As an engineer, degreed in engineering, you talk about wrap up immediately begins. You start with the end in mind. So there was so much going through my mind at St. James as we were having this conversation about how I was going to wrap this up. But the one thing that was really good, besides the insurance talk, because he said a whole lot of good things that I hope you picked up on, was financial wellness, fiscal wellness, and an open mindset versus a fixed mindset. Because this conversation doesn't mean anything to you. It means absolutely nothing to you if you're not interested in picking up a keyboard, picking up a book, picking up your phone, and doing some research on everything that you heard here. And I said literally everything, because there were so many concepts. There's no way any one person got everything. So the very first thing I'm going to ask you to do is consider, look at the difference between an open mindset and a fixed mindset. We oftentimes talk about our intellectual capabilities, our IQ, but it's also about our emotional intelligence and the things that negatively impact us just because of our surroundings, just because of how we grew up. So in order to move from this financial literate perspective to this kinetic energy about financial education and to actually be able to put these things in practice, you got to open yourself up and actually be willing to do it. Regardless or not, if I'm talking about term or whole life, the whole point of this financial education thing is to do something. And they are not mutually exclusive. Just because I am a proponent of term does not mean we don't rock with whole life policies. I want you all to be financially educated. I want you all to be financially well. And we're not talking about equality or equity. We're talking about liberation. It's time to push to liberation by any means necessary. This is the Expediting Change podcast, and I appreciate you all for consistently pulling up on me. Like, comment, YouTube, Expediting Change. Love y'all.
Open my mind and try to reach yours. Ask myself, why is it you really want to preach, boy? I want to teach more.